Since monetary policy has the limitations that we talked about in the last video, there's another philosophy about monetary policy that's out there. Instead of looking to control unemployment and inflation, this type of monetary policy simply says, we're going to target a certain inflation rate and promote that inflation rate, and we're not going to be reactive against unemployment and inflation. That inflation rate that they target is typically around somewhere between 1.5% and 2.5%, with a little leeway on either side. The idea of that is that if we're constantly causing a small amount of inflation, then aggregate demand is always going to be moving consistently to the right. Think about this like riding a bike. If I'm trying to stand still on a bike, it's unlikely that I can stay balanced, and I'm probably going to fall over and crash. If I'm going too fast on a bike, in the same way, it's likely that I'm going to crash. But if I'm just cruising along slowly, well, I can see problems that are going to occur, and I can adjust accordingly and avoid those problems, and I'm not going to lose my balance. So that's what they're trying to do with what's called inflation targeting. What they do is they set medium-term targets, so it's not a short-term target, it's not in the next few weeks or months. It's not a long-term target, it's not 5 years out. It's somewhere in the medium term. And they're going to adjust the money supply, therefore aggregate demand, accordingly. So if they're saying, okay, well, in a year from now, we want inflation to be 2%, well, that means in 6 months from now, we should see inflation of about 1%. So after, as they're getting closer and closer and closer to that 6-month mark, and they're saying, well, actually, it looks like we're moving a little bit too quickly, and inflation is going to be about 1.5% in 6 months, well, then they're going to shift aggregate demand to lower the trajectory of where the inflation is going to be. Likewise, if the economy is not moving along quickly enough, and maybe in 6 months it looks like they're only going to have 0.5% inflation, they're going to try to increase aggregate demand to get closer to that level that they're looking for. The strengths of this policy is that, especially for countries that tend to have high inflation rates, is that it's going to bring inflation under control, hopefully. Secondly, it's going to be very consistent, so you can predict in 2 or 3 years from now that the economy is going to be very similar to what it is today. That predictability is very important because consumers, like we talked about with rational expectations and that problem, consumers like to be able to guess and anticipate how the economy is going to be. It takes away that desire to try to game or beat what the government's doing because it's always just doing the same thing. Same is true for businesses and investment. Likewise, for fiscal policy, we talked about that oftentimes what monetary policy and fiscal policy are doing end up counteracting each other. So, if monetary policy is always just a smooth, firm base, it allows fiscal policy to perhaps be more effective because it's not being counteracted by monetary policy. The weaknesses, well, because it's very limiting, basically for the government, you've taken away half of their arsenal. They have fiscal policy and monetary policy, but they can't use monetary policy anymore if they're inflation rate targeting. So that's a bit limiting. That can be a problem because it might mean in the short term that there's going to be higher unemployment or higher inflation than people are really comfortable with. And obviously that's going to create a certain amount of political pressure. Even in more democratic societies where the central bank is more independent, you still might hear, newspapers or politicians saying, the central bank, they have to change what they're doing. This isn't okay. And maybe people have to respond to that. A major weakness is if there is cost push inflation, there's really nothing that can be done. Remember, cost push inflation happens when there's a supply shock, so maybe oil prices go up very quickly. And if this is the target inflation rate, there's a supply shock and price level goes all the way up to price level 2. Well, what do? Do you decrease aggregate demand to get down to the target inflation rate? If so, a decrease of aggregate demand is going to pull YFE even further to the left, meaning more unemployment. Okay, well then, do you increase aggregate demand to get back to YFE and bring the level of unemployment down? Well, if you do, it's going to result in even more inflation. So you're kind of between a rock and a hard place in that situation in particular. Lastly is that you never know what inflation is right now today. So if my inflation rate target 6 months from now is 1%, and now it's 3 months from now, halfway in between that, I don't actually know if inflation in the last 3 months has been 1%. It takes a long time to compile that data and actually figure out what it is. So you might be changing what you're doing, the fine-tuning that we talked about here. You might be changing what you're doing based on faulty data, which is obviously going to limit the effectiveness of what you're trying to accomplish. If you have any questions, go ahead and put them in the comments below.